morning, everybody, or good afternoon, depending on which part of the world you're in. So I think we got 2 o'clock here, so we can probably get started here. I think any time. So we have David Kruse of Commstock Investments. I'm Matthew Kruse. We're going to be going over with you the 2023 commodity market outlook. And so I'll hand it over here to David. I think as you have any questions, feel free to type those in. There is a button at the bottom that says Q&A. Don't necessarily wait until the end. Just kind of type those in as we go along. Yeah, I think that's about it. So there will be a recording made available to everyone after this is over. And so yeah, I think with that, I'll hand it over to you, David.
Okay, thank you, Matthew. I guess I probably should explain when he says 2 o'clock, it's 11 o'clock here in the United States. He's in Minas Gerais, Brazil. I think he's probably enjoying a lot better weather than we are here this morning. Got a pretty good little ice storm going here, and to the north of us, they've got a full-fledged blizzard. So I'll bet it might be raining outside there, but I bet he's going to enjoy the weather today more than we will anyway. But we'll get started. I guess I am starting with the weather. The first thing I'm going to highlight here is what La Nina looks like in the Pacific. I got to get my cursor here to cooperate with me. There we go. All right. The blue water is cold water. Goes clear over to about Tahiti. And I want people to know that I'm going to check this out personally for everyone here in next March. It's the trade winds, and the Australian Bureau of Meteorology, they track the trade winds in Tahiti. And this next year, I'm 70 years old, and it's my 50th year farming, and it's also going to be our 50th wedding anniversary. So my wife and I are going to check out the La Nina over here in the Pacific personally here come about next March. But anyway, that's what it looks like. It's, as I mentioned, it's tracked by the Southern Oscillation Index, and then that's where they measure that around Tahiti. To have La Nina conditions, you need to have a positive 8 90-day SOI. You can see that currently it's 13.3 for the 90-day, and actually the 30-day is still over 8 itself. So there's still a pretty relatively strong La Nina there. The La Nina, or the Enzo, I guess, between La Nina and La Nina, they El Nino and La Nina, they tend to breathe in and out. And you can see here, there was a while here when it was easing. And then now it's come back and strong again. But if you look at what that average is for the 90 days, it's still very solidly in the La Nina category that way. What's it going to do here in the future? Well, this is one of the models. It's the one that I think that one of the climatologists that we follow, Eric Snodgrass, has put out in his materials. What it basically says here is there's about a 90% chance of a La Nina during the November, December, January. And what they see at that point in time is this La Nina finally fading. Here in next month, they're looking at lower percent chance. Getting to January, February, March, and into 2023, still only a 50% chance that it'll be around. And they've got it as you go forward here, going essentially away into spring, and they see the revival here of an El Nino pattern, back the other direction. Just as a general statement. There's about a 70% chance of a below trend line yield of the Corn Belt in years that were, La Nina. There's about a 70% chance of above trend line yield in years that are El Nino. And so what this would be forecasting is that we're leaving, negative crop condition climatology for some improvement in this next year, better chances of higher yields. I will add the caveat that at about this time last year, these forecasters had the same forecast. And what happened in actuality is it did dip. And then instead of going down and doing this, it came right back up. And it didn't go away last year. And so, there's a degree of unreliability in these, but maybe I guess their idea is that they think they had the forecast last year and it didn't happen. That makes it more highly likely that it'll happen this year, as you're into like 3 years of La Nina, and it is due for a breather, for a change there on that aspect of it. Now, looking forward here, we'll look at this. This is what the forecasters think that the water temperatures are going to do in the Western Pacific, and kind of, a little bit of a circle there to give the idea of that. Looking at conditions that are typical for a La Nina, what generally the conditions are is it's good crop conditions for Brazil, for most of Brazil. The southern portion of Brazil and Argentina has the tendency to have drought during the La Nina timeframe, and then again more hotter temperatures on the temperature charts, more normal up above, and that's generally, if you take in the average out what happens in Brazil, there's usually enough good crop producing areas to balance off whatever's not so good in the south, that they end up with a normal crop. The losses from South America tend to come from Argentina. And the current situation there as it exists today is really in line with what would be normal, which you would expect for a La Nina condition. We'll have to see how it is going forward. Again, this was back the 1st of December approximately, and it was very dry in this portion of Brazil. Not surprising. Some of these areas I think have picked up a little more rain. I know back at that time where Matt is in Minas Gerais, it was dry. They had what they call a veranico, a little short-term thing, but they've since gotten some pretty good rains. I don't know if I got it right where you're at, Matt, but it's somewhere over here where my cursor is, isn't it? Where Minas Gerais is. But anyway, right now, the general trade too is fully anticipating that we're going to have easing La Nina conditions. If that, the crop in Brazil is primarily made in March. March is our August. And so what their anticipation is if this La Nina fades, then that we'll see much improvement in some of these areas that have been under drought. It's not going to fix, even if this happens at this point, it's been so severe in Argentina, it's not going to fix everything. They're very late in planting. And there's really nothing in the forecast today, at this moment that says there's any change in the offing for Argentina. Little improvement here and there in Brazil. The trade in general, USDA, I think, is 152 million metric tons is what they're anticipating for this year's, another record crop. When they add soybean acres, there's a tendency to add second crop corn acres. And if there was a fading or a withdrawal of the La Nina, that would probably be good news, but for the second corn crop there at that point in time. So the way it stands right now, essentially most of the trade expectations for weather in South America is for some good conditions and record production. And I would point out, however, that it was no different last year. They were looking for record production and stuff last year, and they got this. Things didn't come through as what they expected, and so there's weather's still an art, not more than a science. It seems like. Looking at this country, I guess this is what you'd expect from a serious La Nina. Why this is happening here too. A great portion of the Western Corn Belt and the Plain States are still in severe drought. Essentially, there's a slice right in here that's been much improved. It's where the good yields were this year. In the Corn Belt, the best yields. Everything you get off this way. Found out that irrigation isn't the whole solution. To this. When I was in the Delta recently on a trip into the South, those guys down there were talking drought just as much as we were up here. And they were looking for some relief that way. Again, when it gets hot down there, the temperatures was a lot of what happened to them. They've got some pretty good irrigation capability, but it gets too hot and it doesn't work. This is the subsoil moisture conditions. And right now, here where we're at in Northwest Iowa, we've got pretty much zilch for subsoil conditions. We can hold up to 11 inches of water in the ground in our soil profile, and we've got just about nothing. It's about as the driest when we went longest into the fall that we've seen in many years. What made our crop last year was our subsoil moisture. We were fortunate enough going into the last season to have a full profile, and so you get to August and it didn't rain, but it wasn't so hot where we were that the plants couldn't go down into that subsoil structure and pull up moisture. And actually I ended up with an APH or a slightly higher yield where I live. Some areas was all came down primarily to soil type, crop rotation, some of those things. There were some very poor yields, but there were still also some good ones where conditions warranted it. Again, the best yields this year were in this slice in through the center, and so that still sets them up pretty good for next year. I guess there's this old adage that plant in the dust and the grain bins will bust. And I'd say over here where we're at in the Western Corn Belt, we're going to test that out. It's hard to imagine how we can go into spring. Snow doesn't go into the ground that moisture when it melts very much. And so it'd be hard to get much. If we could see some favorable spring recharge, some good spring rains, it'll help a lot. But we're kind of in somewhat dire straits right now for that. A couple of charts here that just did show where the last conditions were. There was like 66% of the corn production was within these areas that were producing, were experiencing drought. Again, here for soybeans is actually a little more, 68%. Even as I mentioned in those in the Delta region where there's more soybeans and such down there. They aren't in very good condition either for as that goes. So we're going to go into it guarded again. The trade, I would have to say, is not taking this very seriously. They are of a mind, just I guess, as they are in Brazil, that we're going to see a significant change in climate weather pattern here, from winter into spring. I guess we'll end up testing that out. Time will tell. USDA just recently updated its supply demand in the last week. The primary change in the corn side was a 75 million bushel reduction in corn exports. We haven't seen much at all to speak of in the dailies, and it appears that China's plans on going to Brazil for predominantly most of its corn. And if you looked at the year-to-year change, it's substantive. Last year we were 2.471 billion bushels of corn exports, and now they're projecting 2.075. This was anticipated by the trade in the market. The market had fallen ahead of this report. I know many in the trade expect even a further downside reduction, maybe as much as 75 million bushels more. Again, I'm probably skeptical of that. I think some things could happen here that, or at least the things that are developing in the right direction, that will help relative to maybe we can see some resurgence in corn exports before this is over. Looking at a percentage of of what the exports are of total corn demand. This is a standard grain chart, but I don't think it was, we updated it for the most recent report, but it's just a fraction of a change. But you can see that exports only are 15% of total corn demand. And so, as I've described in a recent report, they are the tail wagging the dog. However, if you look at the Chicago Board of Trade, it is a physical delivered contract, and the delivery points are essentially on the rivers, the Illinois, Mississippi River, and it is the export market. And so while we look and we say that, gee, only 15% of corn demand is reflected, by exports, much more high percentage of that is what is being price discovered by the Chicago Board of Trade. They are, after that, everything else is basis. Where the corn demand for ethanol and feed is in the western corn belt and the plain states, it's correspondingly is the basis there. This is also the area where they got the best crop this last year. Is where around this region that actually is from the physical delivery aspect of it for the Chicago Board of Trade. And of course, the other areas, the farther you got away from this, as the crops perform less well. And so there's less supply as you get away too. And so we're seeing one of the largest basis differentiations that frankly I've seen in my lifetime here in agriculture as a result of this is varying fundamentals. One of the other aspects here that impacts exports is, of course, the U.S. dollar. Right now, this chart would need to be updated. I think we're moving the cursor over here underneath about where we're at right now. We're actually sharply lower today. We're at 103.87. And I guess it bothers me just a little bit. The corn market's kind of struggling in the wheat market too, to respond to that. We've been setting back in the dollar, and it hasn't been an immediate response there. We've essentially what we have to do to fix the Chicago Board of Trade is go, I suppose, to a level where we resurrect some corn exports, and we'll talk about a little bit of that further in the presentation here. But if that's going to depend on the availability in Brazil and the availability out of Ukraine as far as the competition is concerned, it might not be quite as bleak. This gives you a little picture of where the dollar is. As a general statement, as I look at the 50-year history of the dollar index and how they impact ag exports, is that everything goes pretty well at around par at about 100. We can, as long as we're under 100, we come up to 100. We've seen some really not a lot of impact on our exports globally. When it gets above that, however, and you can go back, though I wanted to include the 50-year history because it includes the ag depression of the 1980s, when they took interest rates to 18% and pulled in all the capital from around the world. They were selling every other currency that was out there, buying dollars to put into U.S. treasuries. And that was the big thing. And so it made this huge, surge or whatever in the dollar. And we saw just a little bit of a taste of it here when we had our inflation and the Fed started to raise interest rates here. And that's what that was about. And so probably the weakness in the dollar is anticipating that what the Fed has been doing is working, and maybe that the Fed can at some point here soon start to pivot, or they aren't going to bring interest rates down for a while. But certainly the rate of their increase is likely going to slow down. That's expected tomorrow, with a 0.5 point increase instead of previous 3/4 point increases. But that's we need to get exports going again. We probably need to get that dollar back to par, I guess, is where I would think it'd start to get optimistic. I mentioned where are we going to get the exports from for competition? This is the ports on the Ukraine. Right now, the biggest one that's been moving out in the corridor is what they call it, has been Odessa. This last week, Russia was capable with their missiles of taking out all the electricity in Odessa. And you can't load a ship without some electricity to run the machinery. And so things came to abrupt halt there as far as loading is concerned. I gotta go ahead and see what I've got. Well, I'm gonna back up one more time. Also, as I look at what the situation is in Ukraine they've got 45% of their corn that's still in the field. Won't be harvested this fall. They have no way to dry or to handle that corn, and so their best option was to leave it into the field. And they're, I imagine in the spring they're going to try and go out and salvage that whatever they can. The cheapest world corn at the source in the world, it would be in that field in someplace in Ukraine. And China was reportedly coming back with some interest in Ukraine corn, and it may be the cheapest in the world in the field, but the risk and how much you have to go through to get it out of there ends up making it not so cheap. It's going to be difficult, I think, for Ukraine, to compete. So then that puts the focus on Brazil. And it seems like every exporter in the world has suddenly gone, oh, we're going to get all of our supply from Brazil. And that seems like might be an overstatement too for how that's going to happen. I mentioned the problem that Ukraine is having, and I think this little dot right here is Odessa. And Russia's been having some great success in turning out the lights in Ukraine, and actually that little dot for taking one night, I don't know, a week or two ago, that would be dark too today. The biggest demand feature in Ukraine right now is for electric transformers, and the Russians have been very effective at knocking out their transmission and all the different electrical grid. And they can fix it, and it'll run for a little while until the next missile comes in and takes it out again. And then pretty soon, their ability to fix it gets pretty hard to maintain. And so as I look forward here, I think the reliability of much grain getting out of Ukraine is I'm pretty skeptical about that yet still. Looking at where we're at in the weekly corn chart, I do follow the Elliott wave when it jumps out at me, I guess. And as I look at this initial decline from the high in corn in a weekly standpoint, it seems to me that I can see wave 1, 2, 3, 4, 5 waves down. That does indicate that this is probably a substantive major high. We had a corrective rally, and it's kind of rolled over, and here we are here today, and that we're now formed a downtrend line, coming off of that. There's a couple of different, possible interpretations of what could happen next for the future. After you get a 5-wave decline, you typically get a 3-wave rally. That doesn't look, in this case, very, you have to be a little imaginative to see 5 waves in that. But if that's the case, that could be A, and you'll get a B in here, and you'll get a C back up. That's still possible. Although I'm going to show you the shorter term here, outlook on it on that chart a little bit, and it's maybe not quite as optimistic. I lost some of my optimism here, I guess, a couple of weeks ago when we went to a new low here. And the reason for that is, as I said, the major trends tend to move in 5 waves. And the way this jumps out at me is wave 1, 2, 3, 4, 5 waves down. And so that changed my anticipation that this could be a significant high. A lot of downside risk at that point in time on the chart if this would happen. And I've since set up some recommendations for advancing our sales up against what would be a resistance area if this happens. I would expect a 3-wave rally. In other words, A, B, C, something like that. on that part of it, and be able to take a little bit of time. But maybe hopefully we can get to our objectives and get some sales advanced. And otherwise, when it comes to Christmas, we're probably going to start pulling the plug on some anyway. On that aspect of it, just because this chart to me looks pretty guarded, and we've only got 15% sales made so far. I'd like to be further ahead, I guess, than that at this time. Looking over at the soybean balance sheet that was updated here by USDA for December, and you know, it's a lot more optimistic. You know, if I look at the year-to-year change in exports, it's at this point in time, it's only 50 million less, and they've actually, the export at this point in time is actually ahead of last year. So they expect that these exports are going to slow down as we get later into the year, and Brazil takes over when their crop comes in, and maybe that'll come down a little bit further. The bears, I'm going to say, also expect that the USDA may increase this yield slightly more in the January annual crop production report. And so it wouldn't be very hard to see this, you know, another 25 million bushels from each category, and putting this up to 270. And so the odds of it getting probably tighter, you know, again, the bigger factor is going to be what happens in South America. If they, you know, they had their best forecast for last year's crop about now, and then it unraveled. And if it unravels again, well, then that will help our export demand, and it will help keep this tight. And so there are ways, but right now I'd have to say the trade is pretty skeptical and negative on all aspects of this stuff, as far as the weather, as far as the exports, as far as the macros. Seems like we're dealing with a lot of bears right now. This is looking at the soybean weekly chart. You know, looks to me like what we've put in here is a large triangle, and the next major move is going to be whichever direction out of this triangle that the price action breaks out from. And so, you know, we're at the moment we're up here, you know, testing resistance. You know, and again, as I've been saying, if something doesn't materialize more favorably in South America, you know, then there's that possibility we could see an upside breakout out of this chart formation. If starts raining in Argentina, and they start adding to South America's crop situation, well, I think we can guess which way that this chart formation might break out otherwise. You know, here too, this is looking at the January chart. One could argue that we've been flirting with some upside breakouts here. We keep coming back and testing things. The market, this is yesterday, it's up today again. And so we haven't done chart damage, let's put it that way. For a lot of the chart purists to believe that you're going to get an upside, that it's an upside breakout, they like the secondary rally within the triangle to be exceeded. And that's this level right here. I think that's about 508 actually in the March contract. It's a little bit different between the two, but you'd like to see closes above that. Then you open it up to the highs. And quite frankly, if you did what the triangle objective would be, it would get up there near $17 again. And so, you know, there's a lot of we've been advancing our sales into the strength. Still going to stay a little reluctant on new crop sales yet until as we see this thing unfold. I sense that there's a lot of negative trade sentiment here. You know, if you're a contrarian, maybe that's not so bad. You know, we had a significant upside breakout in the soy meal market. Again, as I'm looking for 5 waves to unfold, I would think it's possible that you could make one more short spike high up above this for wave 5 from this down here. At that point in time, I would be neutral, or my bullishness would kind of go away. Now, this is really the result of a really heavily wound up soy oil spread. And went for multi-months where the trade was all bulled up off of the biofuels news and stuff for soy oil. And they were just buying oil and selling meal. And then when the FDA came out here, not the FDA, the EPA, excuse me, came out with some maybe less optimistic, potentially more skeptical projections as far as what they were going to do with the biofuels. What happened is this trade that was heavily inwound, massively unwound. And so what we saw then is huge short covering in the soy meal and a large break to go along with that in the soy oil. Here again, if the meal could make one more new high and soy oil could make one more new low, then I'd get kind of neutral probably on both of them at this point in time. But as far as the soybean market was concerned, actually soy meal is the larger product. And so this didn't harm, crush margins as much as what Mike would have thought the soy oil, because that value was restored from the soy meal side on that. So looking ahead to next year, this was the USDA's baseline projections. They're going to update these again in February. But their initial look forward into 2023 is they were thinking they were going to see a 3.4 million acre increase in corn acres. It's not, a little more sorghum as well. Then on where they're going to come from primarily, and I'll talk about this a little bit later when I show you a cotton chart, but it's going to come out of cotton is what they're saying. I'm skeptical. I've talked to people in the South, and they think most of those acres are going to go to sorghum. They won't go to, some in the South and the Delta may go to corn, but otherwise, in Texas and whatever, it'll go to sorghum on that side of it. They really don't look for much of a change in beans. Actually they were a small, decrease at this point in time. And I'm skeptical about all this, I guess, as we look forward about whether there's actually going to be that's going to work out. This is a standard grain chart, I guess, and then what it shows is this is the theoretical comparison that's been used by most of the trade, is that 2.3 is the number they picked, that if the ratio corn soybean ratio is 2.3 and if it's under that, you get more corn acres, and if it's over that, you get more soybean acres. Well, the current ratio today isn't too much different than 2.3. It's about hanging right in there. It hasn't changed too much, but I'm skeptical of this, that this is an old line benchmark, and that our cost structure hasn't altered that. I know that in my thinking, if I can get $7 corn, but it's only $6. December new crop is nowhere near at that level, and if you took December new crops, the twos, corn and soybeans, you end up with like 2.32. I calculated a little bit earlier today, but in my opinion, I think the real number is more like 2.15. I'm not in this camp, I guess, that thinks that we're $6 new crop corn futures and $14 new crop soybean futures is going to get you that much more corn. We don't seem to understand. Seed corn prices are higher, fertilizer prices are higher, and then a lot of that is avoided on the soybean side. I'm going to do rotation, but for agronomic reasons. But that's kind of where I guess my thoughts are on that. Again, here we are showing this 23 corn. We've set back here under $6. The chart isn't looking that friendly yet, but charts change, and it's got a big discount in this thing already, going out here ahead. I mean, they're basically in this, they're anticipating that our drought is going to go away, that Ukraine is going to restore their exports, that Brazil is going to have a record crop, and all kinds of things, and that it seems to me that's in that number. And but basis is a lot of it too, as far as this regional disparity. I'm in an area where we're 60 cents over, And honestly, if you were, I wouldn't be feeling as maybe quite the same if I was over in the Eastern Corn Belt. Here's the soybean chart. What I find interesting about this is right now, you listen to RFD TV and every analyst on there, I'll be selling some of these beans up here $14. Well, people have been doing that. I mean, obviously that's a barrier, but this was also an ascending triangle. And so if we can get closes above 14, it should at least move this much higher on top of that, and maybe further, as you really got quite a consolidation, and so if you ought to be up here, and I calculated the objective was about 1480, and if we would break out to the upside and get to 1480, then I would consider some new crop at that point in time. But until that happens, it is not an impossibility for this chart formation to fail. And it would be a failure of an ascending triangle. It's happened often enough that it's considered to be an alternative chart formation. But you can see here quite readily where the support is. And at this point in time, we've stopped to resist. We're winding into an apex. And probably, we're going to have a better outlook on what's going to happen with the South American crop shortly. And that's probably going to have a major impact on the resolution of that chart pattern. Where are we at on inflation? Interesting. I wanted to go back. I was around in farming through my first year was 1973. So this will be my 50th year. And what I went through there in the 1970s and into 1980 with inflation. And what I saw back then is that I guess there would be some pullbacks and it came right back on. And that means that the Fed at that time didn't maintain any restrictive monetary policy, that as soon as things started to ease or pull back, they let up and boom, she went up and took off again. I just don't see that same situation as applicable to today. I guess the day's report shows that the Fed action and tightening the money supply and the monetary policy, it appears to be diminishing inflation. And I guess I thought that at least a one-time price adjustment from all the things we went through in COVID and all the ramifications of the disruption of global supply chains was relatively worthy of a price adjustment. I think that's what we got here. And so are they going to hold on so long that they break the economy and force the world into recession? Seems like a poor medicine for a cure. At the same time, I'm not anticipating that. Why isn't so we got 7% inflation or whatever it is this year. I'm pulling a number out of the air. Why is it going to be another 7 next year? I don't think so. I mean, once we're right now comparing, month to month, but when we get to the point where we're comparing next October to this, next December to this December, might not be much difference in price at all next year. It might be 1 or 2%, and then I guess the Fed can declare victory. As far as that go, how fast they go about, easing up or whatever, it'll be interesting, but time will tell. It is, we're up here now. This is a little bit of an old chart too. Boom, we're up here going for 4. They say we're going for 5. That's we're just going to do a little slower now. We've had these 3/4 point hikes, and now we're going to get a 50-point hike. Maybe the next one will be 25 points if they continue to see the inflation rate moderate like what they want to see. But this is the sharpest, hardest, fastest, adjustment in monetary policy that we've seen, and it beats the 80s, and such in that point in time from what we've experienced ever before. And so they got on this thing hard. And so, hopefully it'll have the right effect, maybe. Looking at where the consumer is today, the consumer, generates 70% of our economy. And this is the savings rate from the Fed. And you can see when we went into COVID and everything shut down, nobody could spend any money. Savings accounts, checking accounts, all the cash built. Started to come out of it, started to release again, here down, had the second wave, again, where things were shut down. And now we're spending. You can say, well, eventually we had a bunch of cash over here that would be able to afford things, but so we didn't have to pull from savings. But I don't know if this is quite as negative as people are trying to make it, but I guess time will tell. I guess one of the things that gets me the most about this situation is comparing it back to the 80s or whatever, is that we don't know who gets caught this time. Back in the 80s, the banks got clobbered. I mean, farm banks were going broke right and left. Farmers were going broke right and left. Businesses, everyone. I mean, the interest rates, everything, it just killed the whole works. But everyone had been leveraged. Back at that time in the farmland situation, they were land bank was loaning 90% of the money, and it was on a very favorable appraisal. And everybody got in. So when the market started to decline, it caved right back in on itself. When nobody could afford the service, those types of that type of debt. And so, but this time, our banking system is about as solid as it's been in modern history for this country. They're all in good shape. We can talk about the home loan or the home situation, but everyone that bought a home's got it all locked in at 3% or whatever on the ones that they got. And so, yes, it'll slow down future sales and such like that, but there's nobody caught that's got to unload houses or anything else but from this. Again, in agriculture, I think we're in pretty strong financial condition. Bankers that I talk to tell me that some farmers have been paying off their lines of credit, and looking pretty darn solid as we go forward. So nobody's really been caught by this jump in interest rates so far, to the point that it's cause a bankruptcy, I guess is what I'm saying. Not that there isn't some signs of distress underneath here, and I'm going to point out the bottom chart here. This is one that I just pulled out. Everybody's got, a lot of people got 401ks. I don't, but when times get tough and you need money, and here's the only place you can go. There is such a thing as you have to qualify, but it is a hardship withdrawal. And we did see a kick up here in the hardship withdrawal. So there is some stress out there, and then some aspects of it, on that part. Another sign that everybody always looks to is yield inversions. When the short-term interest goes up above the long-term interest, that's a yield inversion that has preceded most all recessions that we've had in the past. We are now seeing a yield inversion. From the lower interest rates on the short term to have now gone up above the long-term ones. And so, that is a sign that's out there. It's pointed to by many bears that, this means for sure, we're going to have a recession. I think one of the things that's probably helpful as we look ahead to this next year is the consensus for a recession. If you go on CNBC, and it's pundit off of analyst after analyst, it's not if we're going to have a recession this year. It's just either it's going to be devastating or mild, And so I think that's the way I read the consensus as being here today. And this chart's not updated, because if it was, I think the S&P took the news today of the easing of the inflation positively. It's sold off considerably from the highs earlier in the day, but it's up here testing the downtrend line. That's been in this thing. And I point out that markets are generally forward looking. And my experience in the past is if there was a recession ahead, the stock market's usually in full anticipation of that. And it usually bottoms just ahead of when the recession is fulfilling itself to I guess, to the market pundits. And at this point in time, it's not. I will also point out that I noticed this day right here, where there was another one of these government reports that was very negative. It was horrible. And the market barely opened lower and then closed higher. It ended up closing. It was a major key reversal. And the worst news comes at the bottom of a market. And it was and the market had been falling and falling, from this high, dropping down there. It was a horrible day as far as what the news were, and the market closed substantially higher. And that caught my notice that particular day. That was classic. And then we have followed through the upside to the point where we're testing the downtrend line. And got all this negative expectations for next year. But what's the stock market doing up here then? It's kind of my idea. But it's maybe not quite as bad as what some people might think. Looking at how crude oil market has responded to things here. We did buy crude oil last week. About this area right in here is what I would describe as a Joe Biden strategic petroleum reserve put. What over here, one of the things I did to generate this big decline was to open up the strategic petroleum reserve globally, and a number of other things took place too. But OPEC was continuing to pump a lot of oil, and we ended up with this price weakness. Well, Biden or the administration had also said that they were planning to start replenishing the oil in the strategic petroleum reserve, below 72, 73. And so when it gets to that area, that doesn't say that it couldn't go down a little bit further. I'm not going to, stand in that way. It is up again today. It's up a couple of dollars. It's at about 76 right now in January. So it's up here with the gain that we've had today. And so we did recommend buying crude oil with looking ahead that this put option from the Strategic Petroleum Reserve would help mitigate our downside. And that as far as the upside goes, I don't know why we can't go back to a level like this and retest that again. And that would be a good hedge, we thought, for 2023, fuel needs and such by buying the crude at that point in time and using Joe Biden's put. So I guess we'll see how well that works. Natural gas, when the weather's moderates, things get better, and when it gets cold, it goes up. And I'm going to jump past that one to the next chart. I think shows the April natural gas chart. I had been previously, and this chart doesn't go back far enough to show it. Last year I had taken a position as covering partly my fertilizer as a fertilizer hedge and such, and got out of it again, and now I'm looking to re-enter. At this point in time, it looks like maybe we've found a pretty decent support area. I don't know, it'll be a nice day again here, and I imagine we'll pull back and fill this chart gap. It has a tendency to do that. Left one here, and it didn't take very long to fill that. But overall, worldwide, there's still logistics problems with natural gas. We'll see what their drawdown was in Europe for the winter, and their ability then to replenish that coming into the next year. This certainly looks like it's going to be a long-term situation with Ukraine, and so their energy situation over there is going to have to be modified, their logistics and such going forward, and it's going to be a longer-term thing. I mentioned earlier that I'd talk about cotton just a little bit. I'm bullish December 23 cotton. First of all, the USDA says there's going to be 4 million less acres. What is there, supposedly 12 or 13? That's a heck of an acreage adjustment. The other thing is that my cotton advisors tell me that it takes 90 cents a pound to grow the stuff. And so when you, I guess that'd be up here where that downtrend would be or whatever. But so that means that you're going to go this entire next year and never give a farmer any chance to even lock in a profit on cotton. And maybe that'll make those acres go down into sorghum or something. Mostly, I think, is where it would go. But, we were buyers of cotton. in this particular area. We also sold 70 or 65, I think it was, strike puts, is what we did. And I got to back up. It was 75 strike puts, and we got about almost $10 cents for that when it was in the throes of this over there. Yeah, and I need to go back and check that. It was either 70 or 75 strike puts. But we just thought there's no way that this thing can keep going down here, or I guess they'd eliminate all the cotton in this country, and nobody would plant any. Anyway, seems like a decent trade. Wheat, not a good looking chart. Again, I'm going to bounce forward to the next one. We were trying to turn here at this point, I guess if things are going to remain into a negative track, I would still think that we have a possibility here. At some point in time, we'll return and retest the trend line. First thing you said, really go back or retest is these lows. So we're in the throes of some kind of a bounce right now in the wheat market. Again, the wheat dollar should help in the wheat. There's one potential bullish account that this after the decline we saw 5 waves down, that this is an irregular B, and you could get a pretty good jump up here for C. I think it better rain or something this spring as far as to help out the wheat crop in this country, or that continue to be a problem. So there's another reason that we've got drought here, and probably the worst crop condition ever in history, the most wheat area in drought at this time of year. And I guess winter is a good time to have a drought, but it's going to have to get fixed later. This is a chart of where they grow wheat in Ukraine, and if you'll notice that most of it's grown in all this embattled area, the part that's being fought over. Hard to grow wheat in the middle of a battlefield. Russians are stealing what they can of it, and the Ukrainians have a little ability to get it to this port. And so initially, when they opened up the corridor, there was like unplugging a huge cork in a bathtub, and they had a lot of ships that were all backed up, and many of them were already loaded, and they poured out of that region, but that's slowing down. And it's going to slow down considerably from that aspect of it, because they can't push it forward. Going to end up here just a little bit of a brief conversation about farmland values. We've had a billionaire farmland market here in 2022. I'm not anticipating here at this time that this billionaire land market is going to continue to go forward. The primary change here is interest rates. When you're back there, when you were borrowing money for 3-4%, that made a lot of models work. Now that's 7% or more. And then also the alternative. I have a family member who I manage some cash for, and this last week I just purchased a 1 year, matures next November, 1 year T-bond for 4.57%. And so as the interest rates make borrowing money tough, a lot more hard to pay back. And then there's also the opportunity loss for cash. On the other side of it, it would seem like we're getting very strong headwinds here from interest rates as we move forward. The Galen Lawrence Group was a very significant purchaser of farmland in Iowa. If I remember correctly, they have like 10 LLCs that they formed, and they were all buying, attracting land or acquiring land in Iowa. We're a major factor in the market this year. It's been interesting that as of this point, that there's been a number of farmland auctions and sales in our region, and we've seen very little to no weakness. We had 280 sell a week ago, and they were still over $20,000 an acre. And so it's not all the billionaires that are supporting this. In general, there's a pretty good financial health, frankly, from the landowners that exist. And so the best buyers at this point are probably going to be the neighbors as that comes into it. am part of my trip south. I was invited through an intermediary to have lunch with Drew Lawrence. It's the son of Galen, and also with their chief CFO for their Galen group, and they told me unequivocally at that lunch that they were done. That the interest rate change was going to take them out of the market, and now tomorrow they'll probably buy someplace else for some reason or whatever. But just as a general statement, they said the interest rates was going to significantly impact what they're doing, and that they were going to put things on pause, and that way. And so, not all of these money people are in the same situation, but it would seem like as we go forward here, that there are reasons to think that at the very least land will flatten out, and it's going to be hard to get gains. And then when we get these interest rates up these levels, where you're getting over 4% for cash, it's going to be it's quite a competition. It's hard to get that out of cash rents and stuff as we go forward. So just thought I'd bring that up for, I guess, the end of it. So I guess, Matthew, I think that's where I'm ending up. And if you've got any list of questions there or whatever thing that we can do shortly, I'd be ready for that.
Yeah, we can take some questions now if you want to type them in the Q&A. One question is going back to the soy meal. If you can kind of go into a little bit more detail about why or what caused the soy meal to go up so much. Was it demand for soy meal or the unwinding of a soy meal bet?
Well, it was two things. Argentina is the largest global producer or supplier of soy meal. And so when they're in this significant drought situation down there, that caused the market concern that was focused sort of on soy meal. The other part of it was frankly, it came from the biofuel situation, and what it did is it triggered a mass exit, of this heavily wound position that the funds had, short meal and long soy oil. And there's no greater bull than a running bear, I guess. And there was a lot of shorts in that soy meal that she started to come out of what had been a long-term sideways consolidation that had built up power. The soy meal had gone flat for quite a while. And when it closed above those chart things and the analogs kick in, and boom, you got this thing. I think that's all got to get sorted out. Like I said, I think there's room for another marginal new high in soy meal as that happens, but I'm probably, it's going to go with the general fundamental situation for what South America looks like and what those prospects are. But, two, as we look forward, one of the things that we're having in the soybean industry is that we've got new crush plants that are under construction and are going to come online next year and in 24 and maybe even beyond. And that is going to increase our domestic, crush. And so our crush margins have been fantastic. And that's, what they say, high prices are the cure for high prices. Well, these excellent crush margins means that there's more people wanting to get into the crush business. And so that's actually friendly for soybeans, maybe not so friendly for the product markets.
I was on mute there. So you kind of indicated that these higher interest rates atmosphere that we're kind of going into now, you're seeing some of the billionaires pulling out. And so I guess what you're saying is that's going to have a cooling effect on the market. And what do you see land values doing? Do you see them maintaining that 20,000 plus acre level or kind of cooling down here in the future? The overall question is maybe what effect, how are our farmers going to have to change their, strategies with a higher interest rate world?
Yeah, good question. One of the farms that sold here recently, I think in the last month or so, was bought by, it was still over this $20,000 an acre thing, and it was bought by a Michigan investor. I think it was a large dairy operation out there, and what their plan is or what they're executing, I don't know. The 280s that sold last week were bought by a neighboring farmer or neighboring farm operation, I think a couple of brothers, and that they already own a lot of land. And, and if they're, and everybody seems like we only want the farm next to us. And so, but evidently there was at least two people that wanted the farm next to them, and because they got the price back up, they're supportive. If you just took the simple factoring of the interest rate change into the farmland deal, it probably should be bringing $18,000 an acre right now instead of 20. And I guess I would expect something like that would happen, where it might take a little while for that to occur, but I'm not. I'm a bull on farmland long term. I own farmland, and if the neighboring farm came up, I would be, and I had any capability, I'd probably be there looking at it, still. And so I just think that it's the best long-term investment ever. It's been that way for our family. But moderate weakness, like I said, there were some people that went to one of those auctions here a couple of weeks ago that it still brought like 21, and that were willing to buy it at 18 because they'd done the calculation on the interest rate change, and that so far there's someone that hasn't happened yet.
Give your thoughts about the cattle again, specifically April cattle. Where do you see the top going in April cattle?
I haven't followed that market as closely as what I have in the past. I know, I guess one of the, today, I think there's going to be some people disappointed. I see cattle after the good inflation report and one thing or another are now, settle back and actually lower on the day. Well, the front options aren't, I guess, but some of them are. And I know there was anticipation this morning that they could have even gapped up and gone, and they didn't do that. I guess that what bothers me probably most about the cattle market is that you cannot pick up a periodical anywhere that isn't telling you how we're just ready to embark on the most fantastic, profitable time ever for the cattle industry. That, if you look at everything that had been impacting us earlier relative to packer capacities and such, that now with the herd liquidation and stuff that's coming forward, supplies, of course, going to, drop off, but it's still just maybe 3 to 4%. And then the other aspect comes down to demand. When I was into the fairway yesterday, I think that the ribeyes were $16.99 a pound yet. And when they get to 20 or whatever it is, it's a tough market to sell that at that level. And so there's going to be a demand barrier. It would not surprise me if some packers cut their kill capacity and moderate that. They know how well that works now. They got a heck of an experience here through all the COVID and everything else about how they can basically manipulate the cattle market with their kill capacity. So there was talk of some of these new entities building new plants and new projects, and here there a few different states. Oh, that bothered, and they're just going right into the wrong time possible. I mean, right when you're going to contract a herd is when you're going to have new plant come on. Those are the sheep that get fleeced, in my opinion. You buy that plant after it goes broke, and that's been the history of the cattle business. And so, while the futures market right now is offering some fairly reasonable, profitable levels, and today's Commstock report is going to have to do with the new cattle price risk insurance policy that though we've in the past, it's something that producers should look at. In the past, it was when I was maybe a little more tuned to the insurance, it was a terrible policy. But they've made changes to it, significant changes to it. And I would say today it's something that needs to be looked at as we go forward. But I'm, right now, if I would be telling everybody about, oh, gee, how high is the cow market going? I'd be just a member of the choir. And I don't want to be a member of the choir.
One last question here. So given the shrinking livestock herd sizes and the hog loss to PRRS, do you see the USDA's most recent adjustment higher in soy meal use for feed kind of coming to an end?
We adjust the hogs by both numbers and weight. And what we've been doing consistently is if there's a few less numbers, we make them heavier. And we end up using that feed one way or the other. We just feed the ones we got longer. And so I wouldn't be looking for that to be any savior as far as feed demand on that side of it. But they get some empty buildings. They just I don't know where is the limit as far as hog weights. You go back 10 years and it used to be 250, 260, and now it's 300. Is that going to be 310, 320? But it seems like that's still been the direction the industry's going, what the trend is there.
All right, well, I think that's all we got. We will send the rest of the recording out to everyone. And if you have any questions, feel free to give one of our brokers a call at 712-227-1110. David, do you have anything else?
Nope. Enjoyed talking with everybody today. So it's been a little while since we've done one of these, and it's better than being out in the blizzard, I guess, what we've got here otherwise. So good day for it.
Thank you, everyone.